This voice is taken from an article with the title, "What is the maximum risk per trade in Forex?" which has been published on TraderTalks.net. The maximum risk per trade in Forex trading is a highly debatable subject and there is no single definitive answer. The risk can vary greatly depending on the individual trader's risk profile and trading plan. Generally, a recommended risk per trade will be no higher than 1% of the trader's account equity. This means that if the trader has a Forex account with a balance of $10,000 for example, the maximum risk per trade should be no more than $100. This maximum risk should also be divided into two parts, with the maximum risk per pip not exceeding 1% of the total risk. For example, if the total risk of a trade is $100, then the maximum risk per pip should be $1. This is known as 1% risk rule, and is widely used by many successful traders. The 1% risk rule is considered the most conservative and safest approach to Forex trading and helps traders to protect their capital from large losses. It also allows traders to take more trades without risking too much of their capital at once. However, some traders may opt to take more risk per trade, depending on their risk profile and trading plan. For example, a trader may decide to risk 3% per trade, or even higher, if they feel comfortable with the risk taken. When deciding on the maximum risk per trade, traders should also consider the total risk they are taking in their trading plan. This means that the trader should not risk more than they can afford to lose and should ensure that the total risk per trade does not exceed the amount of capital they have available. Finally, it is important to remember that risk management is an essential part of trading and should be taken seriously. While it may be tempting to risk more than 1% per trade, it is important to remember that this can lead to large losses if the trade is not successful. As such, it is important to always maintain a risk-to-reward ratio of at least 1 to 2 or better, meaning that the potential gains should be at least double the potential losses. By doing this, the trader will be able to maximize their potential gains while minimizing their potential losses.